Okay, so we're looking at number 52 on the homework for chapter 6. Okay, so form below shows the amounts that appear in earnings to date column of the employee earnings record. 10 full-time and part-time workers. These amounts represent the cumulative earnings for each worker as of October 4th, the company's last payday. Form also gives the gross amount of earnings to be paid to each worker on the next payday, October 11th. All right, so here are our tax rates. SUTA rate. So you can see the SUTA rate for employers and employees is different. So employees do have an amount of SUTA that has to be deducted. In the appropriate columns on the form shown below, compute the amount to be withheld from each employee's earnings on October 11th. Determine the total employee taxes. Record the portion of each employee's earnings that is taxable under FICA, FUTA, and SUTA. Calculate the total employer's payroll taxes on the October 11th payroll. So you said you're having issues with the employer's portion. So were you were able to get the employee's portion? Okay. So obviously, so we've got, let's see, Robert Weisner. Let's see, how often are they paid? Weekly? Okay, it must be weekly since they're going from the 4th to the 11th. I doubt that anybody has reached yet that OASDI threshold. Is that correct? I don't. Sorry? So, okay, so they have reached it? Okay, so. As of October 4th, so how many, did we calculate how many pays that would be then? Let's see, to October 4th. Yikes, since it's weekly. Do they tell you it all? Without having to go through the calendar and look at it? Oh, that's earnings to date. I'm sorry. I thought that was the full earnings for the year. I read that wrong. So earnings to date. Okay. So we know that for Robert Weiser, he has already reached the 142.8 threshold. So there won't be any Social Security taxes taken out of these wages for this period. Right, on either the employer or the employee side. Right, so we should have, so the taxes to be withheld, we would have 0 for him. This is from the employee's portion. I know that you have already done this. All of it would be subject to Medicare tax, right? So $25.96. And then SUTA tax, it's only on the first $8,000 of income, so there would be no SUTA tax from either the employer or the employee's side for this particular employee. So there's the employee's earnings. Now for employer's portion, be the same, nothing for OASDI. Same amount for health insurance, although it may be, because the full amount, so 1790 times 0.029, 5191 minus the 2596. It might be 2595. Let's try that because we've got some rounding issue there. He's way over the 7,000 for FUTA, so nothing is going to be withheld for FUTA purposes and nothing for SUTA purposes because he's over the threshold. Let's see if they, okay, so he don't like that. So let's go back then and try the 2596. No, 2590. Where taxes, portion of employees. That's very strange. No. Let's try 94. No. Let's try 97. I don't know why it would be 97. No. This is curious. Is it going to give me... Is this the issue that you're having as well? None of them. Okay, so you're having issues with both the OASDI column and the HI column on this problem, and you were having problems with the FUTA as well. Okay, so yeah. I think that's what is that what I did?
No, like that's like the number you put in the box.
Okay, they're not asking for the tax. They're asking for the amount that's taxable. That would explain it. Although, okay, so under this column, it's the amount to be withheld, and then the second column, it's the portion that is taxable. So they're looking for two different things. Thank you. Let's see there now. There we go. Thank you very much. That's a little confusing, isn't it, when they're asking for the two different, you think they're asking for the employer's contribution amount. All right. There you go, Shelby. Excellent. Thank you. Other questions? Other problems? And we can go through these again. We can go through them more on next Tuesday as well. So I would assume you might have completed more of the homework by then. Maybe some of you haven't completed it yet, so you might not have those questions. But no other questions? Okay. Right on. So we are going to finish up chapter 6 today. Okay, so we left off, I think, methods of pay. Did we talk about unclaimed wages? Oh, we that's right. So it was Tuesday online. Yes, and I showed you the Great Treasure Hunt online. Iowa's Great Treasure Hunt. So if you can go online there and see if you've got any money sitting in there that somebody has tried to pay to you that they just haven't found you yet. All right. So now we're going to get into those journal entries. As I mentioned, there are several different journal entries that we're going to look at. The first two are recorded at the time that payroll takes place. So when cash is actually paid to the employees, we're going to record those first two journal entries. And so we're gonna start with those two. They're always, as I mentioned here, they're always in the same format, so you don't really have to mix them up, although they would vary from employer to employer based upon, what accounts are being used. What they're calling their expense accounts and all of that. Every time they issue a paycheck, both of these have to be entered. Even if you're only issuing one paycheck to a single employee, both of these entries have to be entered. Okay, so let's look at the first two. The first one, journal entry number 1, has to do with amounts actually paid to the employees. So we're going to start with the total gross pay for all of the employees, and that's going to be our debit. All of our credits, and we started to go through this on Tuesday as well. I gave you a little bit of a preview of these. Everything else is going to be a credit. So that debit is really easy to figure out, because all you're going to do is see what the gross pay is for all the employees. And that's your debit. And because the journal entries have to balance, both sides have to be equal, that whatever we're entering on the credit side is going to total that debit amount. If it doesn't total that debit amount, something is wrong with your journal entry. The credit side of this particular entry, everything that has been withheld, all of the accounts pertaining to withholdings from the employee's paycheck are going to be the credits. So you can see, you can extract all of the information right down here from the totals. FICA taxes payable, $114.39. Medicare, $26.75. Federal income taxes, $170. State income taxes, $50. And then our insurance, which of course is not a tax, but it is an amount that's being withheld. So any amounts being withheld from employee paychecks, those would be credits in this particular journal entry. Insurance total amount for all employees, $191. And then the net paycheck that's actually being issued to the employees is going to be our final credit entry, and that is going to be a credit to cash. So remember, cash is an asset. To increase assets, we debit them, which means to decrease them, we're going to credit. So, because it's money going out, that means that our cash is going down. We're gonna credit that. This is the first journal entry. So, and this would, like I said, once you've got the employee or the payroll register completed, all of that information is right there for you to create that journal entry. Questions about this journal entry? Pretty self-explanatory? Okay. So that's the first one. Second journal entry, we're still going to extract this information from the payroll register, but then this one is from the employer's side. These are the amounts of payroll taxes that the employer is responsible for paying. Okay. Our debit in this case is going, they don't have a total here, but it would be the total of all of these amounts. So if you don't have a column that is totaled, you might actually want to start with the credits, because they're all listed there. So we've got our food and taxes payable. Remember, that's a liability. Anything that has the word payable attached to it is going to be a liability. Liability is not an asset, an expense, or a dividend. So to increase it, we're going to credit it. Decrease it, we're going to then debit it. So food and taxes payable is our first credit. Again, it's coming right from the table. Student taxes payable, as well. FICA taxes payable, and of course this matches the employee side here. And then the Medicare taxes payable as well. You add all of those up, and that's your debit. You can just plug it. You know, you can do the credits first, enter them in, and then plug, add them up and then plug it. If on your table you actually do have a total, you can just use that total for all of those. But payroll taxes, now I had mentioned that, those expense accounts, it's nice when they've got the word expense attached to it, right? Because then it tells you it's an expense account. In your book, they don't use expense for the payroll taxes account, but this is an expense account. So, in real life, you could call it payroll taxes expense, but you do want to make sure that it says payroll taxes, because the company may have other taxes to pay, right? Sales taxes, property taxes, income taxes. It may have other types of taxes that it has to pay. So it's best to specifically state the type of tax here that is being paid. Questions on this journal entry? No? Okay. All right, so let's take a look at this question here. We've got Cronus Chemicals. They're liable for a FUTA tax of $1,200. What would be the journal entry to record the FUTA taxes payable? All right, so it's a payable. So we've got a liability there, which means, and to increase any liability, we are going to credit that liability account, right? So we know that we're going to have to credit FUTA taxes payable. Well, choice A is a debit, so we can eliminate that one. Choice B and C both have a credit to FUTA taxes payable, so it could be either one of those. Choice D has a debit to FUTA taxes payable. Okay, so we've eliminated A and D as potential answers here. So we're going to credit FUTA taxes payable. Are we going to debit unemployment taxes payable? Now we're debiting a liability account at the same time that we're crediting a liability account. The only time we would do that is if we made some sort of mistake and originally credited to the wrong liability account. So we can eliminate that one. We're left with debit payroll taxes and credit FUTA taxes payable. I know sometimes it's kind of awkward to see these when they're not actually in journal entry format. So let's write out that journal entry. Okay, so we're going to debit payroll taxes. That's an expense for $1,200. And then we're going to credit for $1,200. Can anybody tell me what the journal entry would look like when we actually pay the FUTA taxes?
You would debit.
What's that?
You would debit the payable.
Right, then you're going to debit the payable. For the $1,200. And then what do we get a credit? Cash, right, cash. This is cash going out. We're making a payment. So these would happen at two different times, of course. If you're paying it at the same time that you're actually making the payment, then you would, or that you're actually incurring it, then you would just do away with the payable entirely. But, yeah, any questions about that? So anytime you've got that payable that you, and these other journal entries that we created, here, these are all payables. When we actually pay them, we actually write the check, then we are going to credit these accounts. And, I'm sorry, we're gonna debit these accounts, and our credit is going to be to cash at the point that they're actually paid. And that's one of our other journal entries. So remember I said the first two, well, it's actually the first three journal entries, but I kind of grouped those first two together. The first two sets of journal entries, we've got a trigger in that cash is being paid. So that's what triggers us to make those journal entries. In these first two, in the first two, we're paying the employees. That's what triggers those journal entries. In the next journal entry, we're paying the liabilities that we have accrued at that point. And then we've got the final ones, which is our end of the period. We don't have cash that triggers that entry, but we have the end of the period that triggers that entry. All right. So the answer is C. That's good. Glad I got that right. It's rather embarrassing when I get them wrong. Questions about this? No? All right. So once we have all of our accounts, or all of our journal entries, then we post all of those journal entries to our general ledger accounts. Your book, I don't think we've got a good representation here. Let me open up the book. Because your book goes through what that looks like. They go through a different example here, where we got employees that were paid, gross wages were $3,200. Make this bigger, a little bit better. This is what I want. So we've got employees who were paid gross wages of $3,200. All of the withholdings over here on the right, as well as the net paychecks that were actually issued, so that the cash going out. Now, if we had state income taxes included in there, we would have another credit entered for the state income taxes. If they had other types of withholding, maybe a garnishment, maybe health insurance, dental insurance, something of that nature, we would have an additional credit for that particular line item. Okay? And of course that would affect the amount of cash that's going out. Increase our liabilities, but decrease the amount of cash that's going out currently. So once we have entered those, and I know this is kind of hard to see, we then post them to, and the T accounts are the general ledger. Now they don't, I'm sure most of you are familiar with these. You would have gone through them in your intro to accounting or principles of accounting class. The system it doesn't actually look like this in the system. It's going to look different in the system, but when you're doing it by hand, this is very helpful. Because each of those entries then, so we have a T account for each of the accounts that we're using in the journal entries. And this keeps a running tally of all of those journal entries. So our wages expense, we would then transfer from the journal entry the $3,200 debit And again, these T accounts have a debit side and a credit side. Left is debit, right is credit. So the 3,200 entered into the wages expense debit account. And then all of those other credits, you'll see everything else is a credit on the right-hand side. We have a T account for each of those other accounts. So we've just transferred that information there, and it will be a running tally for these accounts. So when we go to the second journal entry to record the amounts that the employer is liable for, their payroll taxes. Again, we've got no cash going out in this case, but we record those liabilities. So we've got our debit to payroll taxes, so we've now got a T account for payroll taxes. We already had a T account for FICA taxes payable, so we're just going to add to that. That's credit. For the health insurance or the Medicare taxes payable, same thing. We're just going to add to that, so that's why we've got 2 entries here. But now we have 2 new accounts, FUTA taxes and SUTA taxes payable, because there weren't any amounts withheld from the employee paychecks, but the employer does owe amounts for those taxes. So we enter those into the T accounts as credits. Okay. Now I think, let's see. I can't remember if this chapter goes through. I think there's a example at the end. I recall. Maybe not. Sorry. Oh, yeah, it's the illustrative case. So we can take a look at that as well. So all of that gets posted to the general ledger. And then when we go through look at the illustrative case, we'll kind of see what happens after that point. Workers' compensation insurance. So workers' compensation insurance is, it's insurance. And employers purchase it through private companies. It's not through, like with FUTA and SUTA, those payments are made to the state unemployment tax fund and to the IRS. But with workers' compensation insurance, employers obtain that insurance through private companies. Now, depending upon the state, employers may be required to have this insurance. In fact, most employers are required to carry this insurance. Now, just like any other insurance, the premiums are going to be higher for companies that have a higher utilization of the insurance. Workers' compensation insurance is in place in order to pay employees who get injured on the job, who maybe become sick from chemical exposure, some sort of illness on the job, or to also pay death benefits if an employee is killed while on the job. Okay, as opposed to unemployment insurance that pays employees when they are unemployed, when they lose their job. Workers' compensation insurance has to do with illness and injury and death while on the job, only while on the job. If it happens outside of the job, workers' compensation would not cover it. So obviously there's certain jobs that are more dangerous than others, right? Construction, there are going to be a lot more injuries on a construction site within a construction company than there would be at, say, a CPA firm. CPAs get paper cuts, right? They may get stressed out, certainly especially during certain times of the year, and that may be detrimental, but construction workers, there are a lot of injuries that occur on construction sites. Agricultural industry as well, there are a lot of injuries that occur in the agricultural industry. So those industries and positions where workers are exposed to more risk are going to carry with it a higher premium that the employer is going to have to pay for workers' compensation. So what usually happens is the insurance company will require the employer to list what it's going to be based on the amount of payroll that they pay each category of employee. So like a construction company is going to have several different classifications of employees. They're going to have construction workers, but they're also going to have office workers, right? Those who are billing. Those office workers, the premiums for those office workers are going to be less than the premiums for the construction workers. So the employer has to provide to the insurance company a list of the payroll for each of their positions. The insurance company is going to determine a rate based upon that payroll, and it'll be stated in terms of $100 of weekly wages paid to employees within each classification. And what happens is that the premium is usually assessed at the beginning of the year, and the employer will then pay it at the beginning of the year, but then at the end of the year, the payroll may be different from what was actually anticipated, and an adjustment would be made at that time to the premium. And the company may receive a refund of their premium, or they may have to pay additional premium based upon what actually occurred. So when the amount is actually paid, we've got our expense account, workers' compensation insurance expense. So workers' comp insurance expense, we're going to debit it. And then we've got cash going out, so we're going to credit the cash at the beginning of the year. So we're going to actually just go ahead and pay it at the beginning of the year, and then that adjustment is going to come at the end of the year. Employers estimate, pay the premiums in advance. At year end, payrolls are audited to determine, okay, what did it actually, were the payrolls in each category, each classification of employment actually what they said the employer estimated they would be. And so the employer is either going to pay an additional premium or they're going to receive a credit for overpayment. So then at the end of the year, if there's an additional premium that they have to pay, we're going to just duplicate this entry because they're going to have to pay more cash. Cash going out again. But if they get a refund of the premium, then we've got cash coming in, so we're going to debit the cash at that point. And we're going to credit that workers' compensation insurance expense. So it reduces the expense for the year. Okay, so we got one of two scenarios, and this is, like I said, this is the end of the year. And this is the beginning of the year. Okay. It's really easy to confuse workers' compensation insurance and unemployment insurance. Unemployment insurance, again, pays for unemployment. It is insurance, but it's not through an insurance company. But workers' compensation insurance is actual insurance, and it is through an insurance company. So when employers go out and get workers' compensation insurance, the different insurance companies may offer different rates, right? So just like, if your car insurance is through Progressive versus State Farm versus American Family, you may get a different rate. Same thing with the workers' compensation insurance. Workers' compensation insurance can be very expensive for employers depending upon the classification of employees that they have. Again, higher risk means higher premium. Questions about that? No? Okay. Let's see. What is this? Okay, so we've already alluded to this. When we actually pay the payroll taxes, that's when we're gonna reverse those payable accounts. We're going to debit them instead of crediting them. Right? So this is this would happen when we are, and again, we've got a payment that's actually happening, cash going out. That's gonna trigger it. We're making the 941 payment here, and these would be separate. You would want to keep these separate. Here we're making the state income tax payment. It's probably the end of the quarter, depending upon how frequently you've got to pay that. And then the SUDA taxes as well. You can see, oh, they don't have the FUTA. Maybe in this case, they probably hadn't accrued over $500 worth of FUTA taxes for the year, so they didn't have to pay any FUTA taxes at this point. They still have to pay their OSDI, Medicare, and the federal income taxes that were withheld. So at the point that we actually make that payment, this is what the journal entry is going to look like. We are reversing those liability entries. So now we're debiting them, and we're crediting cash. Cash is going out, so we're going to credit that. Cash is our credit in each of these entries, and in each of these, the debit is a payable account. Okay. Questions about that? So let's get to these end of the period adjustments. You guys are probably already familiar with certain end of period adjustments. The biggest one is depreciation. For those of you who've taken financial accounting, you know that at the end of the period, that's when you record depreciation. Depreciation is a non-cash expense, so it's something that has to be done at the end of the month or the end of the quarter, end of the year, certainly, to record how much depreciation is being expensed during that particular period. Well, for payroll, we also have some end of period adjusting entries that we have to create. And this can be a little bit tricky figuring out how much. These end of the period adjustments are due to timing differences. So when our payroll period doesn't match up with our accounting period. So for example, well, today's December 1st, so that's a pretty good example. Let's go back to November. If we had a pay period that started, say it started on the 27th of November, it's a 2-week pay period. Started on the 27th of November, and then it's going to end on the 11th of December, or actually the 10th of December. Okay, so for these 2 weeks, our employees, if they worked during these days, any of these days, they're not going to get paid until December. However, we have accrued an expense, we have accrued, or a liability for those days as of the 1st of December, right? Or as of November 30th, the end of November 30th. And if we're issuing financial statements the end of November 30th, we have to account for that. You have to account for those days that employees have worked and earned income or wages, but they haven't been paid for them yet. So as of the end of the period, we are going to have to accrue any wages that those employees are due for those particular days. That's what these end of period adjustments are. So you have to calculate how much is due to all of those employees. Now, you also probably would need to calculate other liabilities like taxes that would be due. Although I think your book doesn't really go through any of that, but in real life, those would be accrued as well, because you are going to have payroll taxes that are due. just a matter of figuring out how much has been earned in wages during that period that where of the within that accounting period that have not yet been paid. So here's an example. If employees earned $2,400 at the end of December, but they're not paid until January. Now, for W-2 purposes, we're not going to include these amounts in employee wages. It's not going to show up on their W-2 because the W-2 wages only get recorded when they're actually paid, even though they were earned back in December. But we would record the expense so that for financial accounting purposes, we have that expense attached to the correct accounting period, $2,400, and then we've got a payable, wages payable. Right, so that's a liability that we have. Now they've noted not an actual payment, no withholding taxes necessary. That is correct, but you would probably want to accrue those payroll taxes that the employer is required to pay, right? So once that's actually paid, so for example, let's go back to our, well, let's look at December, I guess. Oh, December's a nice clean, oh, not necessarily. We could say we've got the end of the payroll on the 24th. New payroll begins on the 25th, ends on the 7th. So we would have 1 week in 2022 and 1 week in 2023. That pay period, that for that week of pay starting the 25th, employees aren't going to get paid until 2023. So if they had, let's say, Monday, Tuesday, Wednesday, Thursday, and Friday, they don't work on the weekends, and of course the 25th is Christmas Day. So, and I'm going to use some different numbers. Let's say for all of our employees, this is what we've accrued. 500 was earned on Monday, 1,000 on Tuesday, 750 on Wednesday, 1,250 on Thursday, and another 1,000 on Friday. So these are all of our accrued wages during that week. Again, so we've got the 26th, 27th, 28th, 29th, and 30th. So we add all those up. We've got 1,500. Is that 50? Yeah, so that's another 2. So 3,500, 4,500 total for our wages, right? So as of December 31st, we would make this entry. Wages expense of 4,500 and wages payable of 4,500. Now when we actually pay the wages, remember, we're also going to have, we're going to reverse this entry, but then we're also going to have to account for that week of wages during the first week of the period. So if they were the same, so we would have, so as of, well, we could also just reverse it as of January 1st. Wages payable. Well, we still have the wages payable. We wouldn't do it as of January 1st. When they actually make the payment, we have January, let's just say it's a week from there. 6th, 7th, 13th? Do I have that right? 13th? Something like that. We'll say it's January 13th. Okay. We're going to have wages expense. If they had the same amount of wages in that second week, we're going to have to record that wages expense again. So this is for the January wages, that January 1st week of wages. we're also going to reverse our wages payable of 4,500. And then we've got cash going out of 9,000. Now, this is a very simplified journal entry because we'd also want to account for all of the taxes as well. But, and I'm sorry, I know that's low down there. But that reversal then at the time that the employees are actually paid would then occur. Another type of adjusting entry that you might make is for like vacation benefits. If that is recorded by the company, the amount of accrued vacation benefits. So you'd have to do that calculation, and then that would be another expense and payable amount. So when an employee takes vacation day, it wouldn't be wages expense or salaries expense, it would be vacation benefits expense, right? So, post-retirement benefits and healthcare pensions, that gets a little bit complicated there, but that would also be another type of adjusting entry that would have to be done at the end of the period. Let's see. Any questions about that? So again, there's no cash going out that triggers this. What triggers it is it's the end of the period. And we've got to make sure that our expenses are attached to the correct period, right? Got that matching principle. Questions? No? All right. I'm not gonna go through that or that. Okay. So that's it for the chapter, the last chapter. So we went through this one again, did kind of a review of the payroll register employee earnings records, talked about how those are used in creating the journal entries. We went through that whole list of voluntary and involuntary deductions, garnishments, that sort of thing. We worked with some journal entries. Remember, we got we got 4 journal entries. The first 2 occur when the employee is paid. The next one occurs when the taxes that were withheld are paid, and then the last category are those end of period adjustments. We do have entries as well when those payroll deposits are made as well. Questions about the chapter? About the homework?
On 52, I just need to figure out the OASDI for Roger O'Connor.
Okay, let's help out Keaton here. Roger O'Connor. So, his earnings to date are $142,510. And in this pay period, he is earning $18,10. So what does that tell you? As far as his Social Security? What's the Social Security wage base?
142,800.
Yep, 142,800. So, before this pay period, he hadn't earned that much, but my guess is during this pay period, he starts to surpass at 142,800. Right, so he was at 142,510 previously. And in this pay period, how much is he? Ooh, it's warm in here. 1810. So after this pay period, he'll be at 144,320. Which means he's gotten up to that wage base, right? How much has he surpassed it by? So 142,800 is our wage base. So we've got to figure out how much of this 1810 is subject to Social Security tax and how much isn't. All of it's going to be subject to Medicare tax. We just have to figure the Social Security tax. So 1,520. He is 1,520 over the wage base with this 1,810. So let's figure out then 1,810 minus 1,520. So 290 is going to be subject to Social Security tax. The rest of it is not. Okay?
Yep.
So we're gonna apply the Social Security tax to that amount that is. And then the rest isn't. Is that right? 42, yes. Other questions? Any other questions? Well, you got me for 28 minutes. No? All right. Well, you're welcome to stick around, work on homework. If questions come up, I'll be here to help. If you want to do that, or, it's